Joining me now is Nick Maroutsos. He's co-founder and portfolio manager at Kapstream Capital in Sydney. Nick, let's talk about the markets. What do you make of the roller coaster ride we've had this week?
The ride just continues to go. It seems like it's risk on, risk off on a daily basis, but certainly erring to the side of risk off. We think that equities are going to struggle to post any gains over the near term and certainly into next year. There's just too much poor data that's out there. And aside from the poor data that's out there, you have government balance sheets that continue to deteriorate. A lot of the elements that are essential for growth, like small businesses, are being hurt considerably, whether it's through layoffs or increased costs through healthcare. So really, it's quite bearish out there. I think the U.S. is pretty much on a road to nowhere. And you will probably see further quantitative easing down the track. You see more turmoil in the markets, or do you see a turn downwards, or what? Well, I mean, just the general level of optimism that's out there is decreasing. I mean, people seem to get excited when they talk about equity markets being flat as opposed to down. So that's certainly a worry for us.
So you think the equity markets are going to be flat for the rest of the year?
Absolutely. I think flat to down, to slightly down. I can't see any reason for equities to be up. The optimism is very poor, and the data that's out there. The recent optimism that was around earnings estimates was a bit misleading because those estimates were already watered down in the first place.
Well, this is it.
So I can't really see where growth is going to come from.
A lot of people are saying these company earnings have largely beat expectations, both in the U.S. and Europe, and those results are cause for optimism. People are saying that, you know, we're being too harsh when it comes to the global economy and not looking at what the companies are telling us.
That's true to some extent, but when the earnings estimates get, marked down further and further, it really doesn't take much for them to beat earnings estimates. So once you see those earning estimates beating them handedly, or analysts actually upgrading those earning estimates, that's when we'll start to think that the economy is actually showing some signs of turnaround.
So where should investors put their money for the next 6 months here?
For the next 6 months, it's going to be difficult. Certainly, debt is going to outperform, in light of the quantitative easing. But I have a hard time, investing in U.S. government debt, given where yields are and the fact that they're printing money faster than they can count. We like high-grade corporates, but other areas that are of interest to us are the Asian economies. Countries like Australia, high interest rates, they've been performing well. They avoided the crisis to some extent. They've been hiking rates. They've left rates on hold the past 2 meetings, but the bias is to tighten. And then you also have other developing Asian economies that are doing well. Countries like India and Singapore and Korea. These countries 10, 15 years ago, they had the will, but they didn't have the wallet. Now you're starting to see consumers come to the marketplace and actually buy things, which is increasing GDP.
Nick Maroutsos, co-founder, portfolio manager at Kapstream Capital in Sydney. Thank you so much for your time this morning.